Easy Wealth Podcast, where learning about money feels easy.
Hey everyone, welcome back to the Easy Wealth Podcast, where we talk about money and wealth in a simple way. I'm Emma. Jack, imagine spending hours researching stocks, studying companies, and trying to find the next big winner, only to discover that after many years, you still might have earned less than someone who simply invested in an index fund and stayed consistent.
Hey, lovely listeners. Emma, this actually reminds me of something that happened at a family dinner last week. My cousin, he works in finance, spent about 20 minutes telling us exactly which stocks he was buying, not just casually mentioning them. He had the companies, the reasons, and a very confident explanation of why he thought they were going higher.
Oh, so your cousin had a stock tip?
You know, every family has that person. And honestly, while I was listening, I started questioning myself, because I've mostly been putting money into index funds. And suddenly I thought, am I being too passive? Should I be spending more time researching individual stocks? Because compared to him, my approach suddenly felt a little boring.
Boring can be beautiful.
I know. And deep down, I understand that. But in that moment, hearing someone talk about a specific company with so much confidence, it made me wonder if I was missing something.
And that feeling is incredibly common, because finding the next great company sounds exciting. But here's the real question. Can anyone consistently beat the market over time? Not just for one great year, not just because they got lucky, but year after year after year?
I guess the answer is, it's probably more complicated than people think.
Exactly. The answer is, it's much harder than almost anyone realizes.
Okay, so before we go further, what exactly does beating the market actually mean?
Great place to start. When investors talk about the market, they usually mean a broad index. For example, the S&P 500 in the US, which tracks 500 of the largest American companies. Or a global index fund that gives you exposure to thousands of companies across different countries.
So, beating the market simply means your investment returns are higher than the index.
Exactly. For example, if you picked individual stocks last year and your portfolio returned 15%, that sounds like a fantastic result. But if the index returned 18%, you actually underperformed the market.
Interesting. So, it's not just about making money. It's about making more money than the alternative.
Right. And this is where things become fascinating. Because yes, some people do beat the market in a single year. Some even manage to do it for several years.
I've definitely seen people sharing their results online.
You often see people talking about their winning stocks. But the real question isn't, can you beat the market once? The real question is, can you do it consistently, over 10 years, 20 years, 30 years?
That's a completely different challenge.
Yes, a completely different challenge. And the research is actually very clear. Most investors, including many professional fund managers with research teams, analysts, and years of experience, struggle to consistently outperform the market, especially after fees.
Even the professionals?
Even the professionals. And that's why understanding why beating the market is so difficult is actually much more valuable than simply being told the answer.
Okay, so why is it so hard?
Let's start with who you're actually competing against when you invest.
Other investors, I guess?
Right, but think about who those investors are. Every single day, the market includes hedge funds with billions in resources, investment banks with teams of PhDs, pension funds, AI trading systems executing thousands of orders per second, analysts who do nothing but study single companies for years.
So it's not just me versus another person on their phone.
Yes, when you buy a stock, someone is selling it to you, and that someone, more often than not, has more information, more resources, and more time than you do.
That's slightly terrifying.
And here's the important thing that follows from that. The price you see for any stock, it already reflects an enormous amount of what is publicly known about that company. The earnings reports, the management strategy, the competitive landscape.
So, by the time I read the news and think, this company looks great,
the price has likely already moved. because 1,000 other people saw the same news and acted faster.
So I'm not finding something others missed. I'm just arriving late.
Most of the time, yes. Now, that doesn't mean it's impossible to find real edges, but finding them consistently, year after year, is extraordinarily difficult when you're competing against that level of sophistication.
Okay, so that's the competition problem. What else?
Let's talk about one of the most counterintuitive things in investing, something called the few stocks drive everything problem.
What do you mean?
Studies of long-term market returns have found something surprising. In a typical broad index, a very small number of stocks, maybe 5 or 10%, generate most of the total return over long periods.
So the majority of stocks are basically average or below?
Or worse, yes. Most stocks, over long periods, underperform simple cash.
That's wild. So the index looks good because of a handful of exceptional winners.
True. And this creates a massive problem for stock pickers, because to beat the index consistently, you'd need to hold those exceptional winners and hold them for a long time.
And you don't know in advance which ones they are.
That's the whole problem. Everybody can see the winners in hindsight. Amazon, Apple, Nvidia. But in 2005 or 2010, it was not obvious which companies would become giants. Many very smart people were wrong.
So even if you're good at research, you might pick 40 decent companies and completely miss the one that grows 1,000%.
And by missing that one, your portfolio lags the index because the index held it automatically.
The index never misses the next big winner.
That's one of its most powerful properties. You can't accidentally exclude the company that changes everything.
You know, there's something about picking stocks that feels active, like you're doing something. You're researching, you're making decisions, you feel in control.
Versus index investing, which feels
Passive, almost boring, like you're just waiting.
And yet, and this is the thing that took me a while to really feel, the waiting is the strategy. The compounding happens in the waiting, not in the deciding.
That's counterintuitive because we associate effort with results.
We do. In most areas of life, work harder, get more. But investing has this strange property where doing more trading, more decisions, more activity, often produces worse results, not better.
Because every transaction is a chance to be wrong.
And every transaction has a cost. Fees, taxes on gains, bid-ask spreads. These things add up. Over 20 years, even small annual costs compound into enormous differences.
So the person sitting quietly, doing nothing, is often beating the person who feels very busy and very in control.
I know that's a hard thing for the human brain to accept, but the data is pretty consistent on it.
Let me bring up the emotional side, because I think this is actually huge.
Yes, let's talk about 2020. March 2020.
The crash.
The market dropped over 30% in a matter of weeks, faster than almost any crash in history.
I remember, it felt like everything was collapsing.
And a huge number of people sold. They saw the number dropping and thought, I have to do something. I need to protect what I have.
Oh, which feels completely rational in the moment.
Completely rational and completely costly, because the market recovered within months. The people who held, even if it was incredibly uncomfortable, recovered fully.
So the discipline to do nothing in a crisis is actually a skill.
It's possibly the most important skill in long-term investing, and it's incredibly hard to have when you're watching individual stocks. Because individual stocks can go to zero. They can stay down for years.
But a broad index? It's thousands of companies.
For the whole index to go to zero permanently, you'd need the entire global economy to collapse and never recover, which historically has not happened.
So holding the index through a crash is psychologically different from holding a single stock through a crash.
The index gives you a rational basis for patience, because you're not betting on one company surviving.
That actually makes me feel differently about the boring thing. It's boring in the way that eating well is boring. The results just accumulate.
That's a good way to put it.
Okay, but let's be fair. Are there people who do beat the market consistently?
Of course, yes.
So what separates them?
Maybe a few things. They usually have a genuine, verifiable edge, a real information advantage, or a disciplined process that most people can't or won't follow. Not a feeling, not a hot tip. An actual demonstrable edge.
Which takes years to build and verify.
And they manage risk extremely carefully. The best investors often talk more about downside protection than upside potential. We covered this in episode 13. The return to risk ratio matters more than the headline return.
Win big, lose small. Over time, that ratio is what compounds.
And I think they are genuinely not emotional about it. They've built systems, and they follow the systems even when it feels wrong, especially when it feels wrong.
So it's not impossible, but it requires an edge that most people don't have, plus discipline that most people can't maintain.
That's a fair summary. And here's the question worth sitting with. If you genuinely have that edge, great. But if you're not sure whether you have it, the index is almost certainly the better default.
Because the downside of being wrong about having an edge is serious.
Years of underperformance, real money, real opportunity cost. And you usually don't discover it until it's too late to recover the lost time.
Okay, choosing an index fund over stock picking isn't giving up on investing. It's making a very informed, deliberate choice. It's saying, I understand the odds, I understand the competition, and I'm choosing the strategy that has the best long-term track record for most people.
I think that's not passive, that's intelligent.
And it frees up enormous mental energy. I don't spend weekends researching earnings reports. I don't panic when one company has a bad quarter. I just stay on the hill.
And that mental bandwidth, you can use it for the things that actually increase your income, your skills, your career, your business ideas.
So the index handles the money growing. You handle the money coming in.
That's a really good framing, actually.
I have my moments.
Okay, one thing to carry from today. The question isn't, can you beat the market this year? The question is, can you beat it consistently, after fees, after taxes, and through every crash along the way?
For most people, the honest answer is probably no. And accepting that honest answer isn't defeat. It's actually how you win.
Okay, quick reminder before we go. Everything we share on this podcast is for educational purposes only. We're not licensed financial advisors, and nothing here should be taken as financial advice. Before making any investment decisions, please do your own research and speak with a qualified professional. We're just here to learn together.
That's a wrap on today's episode. And if this episode gave you a filter you didn't have before, share it with someone who needs it. Give this episode a like and subscribe to the Easy Wealth podcast. It really helps us keep making these conversations for you.
Take care of your finances and take care of yourselves. See you next week. Bye.